12-year high for the NASDAQ at 3378. So things are going very well. And I keep saying that to people, but people don't want to, oh, no, things aren't good. And they're missing all this money that we're making in the markets.
And I don't want to miss that money. Brian, you got to help me. I want to make money.
This is the Smart Investing Show on the AM 760 KFMB. Independent, unbiased, no strings attached financial advice and ideas. Call your host, Brent Wilsey, right now. 1-800-760-KFMB.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, 8:06 on Saturday morning. Great to have you here this Saturday morning and every Saturday morning. Talk about your money, the economy, investing, and all of these things to make you a smarter investor. Phone numbers here, as always, 1-800-760-5362. That's 1-800-760-KFMB. And I see we do have callers coming in already, but I do want to make a major announcement to the show. We have a major change here in the show that is going to definitely be a benefit for you, the listener. And if you're a longtime listener, I know I talk to some people, I say, yeah, I've been listening to your show for 10 years, 15 years, and so forth. Well, many, many years ago, I had my son Chase on the show when he was in Pop Warner playing football. And I've kind of led you through the years with him playing high school football and college. Well, it seems to be that finance is in the genes because he did take an interest in finance and went to Northern Arizona and took finance there, played football, and got a 4.0 throughout the entire year. And now Chase has joined the firm Wilsey Asset Management and also will now be the new co-host of the Smart Investing Show. Chase, thanks for joining the show.
Thanks, Dad. It's a privilege to be here. Been dreaming about it for years now, so.
Went by fast, though, didn't it?
It did.
It did.
It's crazy.
Yeah. And it was so easy going through college, playing football, and getting that 4.0, wasn't it?
No problem, It's just a lot of sleepless nights, a lot of hard work, but it's over now, ready to start the real world.
Yep, and now you got to work hard.
I've been working hard, This is going to be the easy part now.
Yeah. And actually, you had your first week at the office here with us, so what do you think?
It went well. Did a lot.
Yep.
Learned a lot.
And actually, we've got a new segment we're going to do here. And one thing I know people like to know is, like, what do we talk about at the office? Well, and I got to tell you, it's very hard to find somebody that understands fundamental analysis and can actually have a conversation with it. Well, Chase and I, throughout this past week, I now have somebody I can talk to that understands fundamental analysis. And what we're going to do here on the show is we're going to have a segment, and it's kind of hard because the callers come first. I see I already got 2 callers waiting. But we're going to have a segment where actually Chase is going to pull out something from the week that we talked about. And Chase, what is the company we're going to talk about this week that we're looking at?
We spent a lot of time researching Tyson Foods this past week, and I think they're a very intriguing company. They're number 1 in chicken and beef production, number 2 in pork.
Okay.
Personally, I love their chicken. I know how much
you mean
love...
to eat the chicken?
Oh, yes.
Yeah.
No, I love to go pet the chickens, but no, they have a great product, I believe. They also own companies like Jimmy Dean, Hillshire Farms, Ballpark Hot Dogs.
Okay, well,
I know how much you love the Jimmy
let's not
Dean
give the whole thing away here
right.
yet, because we do want to talk about that. Because,
all right.
But again, you can hear already the in-depth analysis that we do at the office and what we're going to talk about. So I think you'll benefit from that. Now, one thing I got to tell you is we will talk about these companies, but we're never going to really tell you if we're going to buy it or sell it, because that's kind of that's for our clients. But we'll still try to help you understand more about fundamental analysis and what we do and how we buy companies and how we manage our $165 million portfolio through conversation. So I hope you'll enjoy that segment. But we do have callers. So phone numbers here again, 1-800-760-5362. That's 1-800-760-KFMB. And let's get right to the calls here. Let's go out to Pacific Beach and speak with Ted. Good morning, Ted. You're on the Smart Investor, Brent Wilsey. And Chase, how you doing?
How are you? Chase, guys, I'm honored to be the first guy to welcome you to the Wilsey Asset Management team.
Well, thank you very much.
I saw a talk one day by Steve Forbes, and he said, "Let me tell you the secret to advancement in a corporation. Nothing succeeds like nepotism."
Oh. Well, that's great. Yeah, I think we'll have a lot of fun doing this. And again, Chase he really gets it. And I've talked to a lot of people, and it is hard to find somebody that really understands deeply fundamental analysis. But Ted, what can we do for you?
I'm looking at Realty Income, a local company that manages like 4,300 properties, and they pay monthly dividends. And its symbol is O, which I always thought was fascinating.
Yes, it is kind of fascinating.
And it just seems like an overall just a dividend winner. It's not paying it's about 4.8% dividend now, but it just cranks it out month after month after month after month, and seems massively diversified.
Right.
So, it's all in real estate, but, 4,300 properties is a lot of diversification.
Well, let me take a look at this one for you. Again, Realty Income Corporation. I do want to tell you that they do have what they call FFO, which is funds from operations. We do look at the GAAP accounting side, which is a little bit different.
Sure.
I won't get the whole details of it, but still, you still want to buy a good, REIT with a good financial system here. So, again, the company is Realty Income Corporation. Symbol is O as in, oh my gosh. PE ratio 43.9, just slightly above the industry at 42.5. So, again, that's kind of normal for the REITs here. Price to sales is very high, 11.4 versus 2.5. Price to book value, 2.4 versus 2.1. And price to cash flow, 17.5. And the industry is not material. Now, you do get a dividend of 4.8%. This is kind of strange because we have a REIT as well. The same thing. The payout ratio is 204. And this gets back to the accounting differences of REITs versus regular companies.
Sure.
We do see their sales are up 16% year over year, better than the industry, up 11%. Earnings climbed by 35% when the industry was down 12%. So that's a positive there. REITs, a lot of them don't have a current ratio because, again, the financial statements. But what's important with a REIT is a debt to equity. I like seeing this. This is very close to the REIT that we have. And we're talking about total debt to equity. It's 89 versus 139.6. And let me tell you why that's so important, because REITs have a lot of debt many times, and when interest rates go up, that's going to hurt the REIT. So it's nice to see a REIT that you have that has lower debt than the industry average. So
let me ask you this.
Sure.
They're showing 8% of their debt is adjustable, and if interest rates go up, I would think that would drive people into apartment buildings and stuff. Although these are not apartments, typically they're rental properties. Commercial, but so people wouldn't be able to afford to buy the buildings as much.
Well,
I would think increasing interest rates would help a REIT if they were fixed income or fixed rate loans.
No, unfortunately, because what they look at is that for that REIT to expand, they're going to have to borrow at higher rates, and therefore interest is an expense, so it can hurt the earnings. So, and again, the long-term factor, you're correct, but short-term being 2 to 3 years, rising interest rates will hurt a REIT because to expand, when they go out and get a new mortgage, they can't get it at 4 or 5%. It could be 6 or 7%, which will hurt their bottom line. But again, we hold our REIT, and the thing to do about it is make sure you get REITs that have low debt, like you're doing here on Realty Income. Let me continue on here. The return on equity is 4.8, about the same as the industry at 5. I do like it to be higher, more closer to 15. Net profit margin, very important, 29.4 versus 5.9. That's very good. They get to keep almost 30 cents on the dollar of what they bring in. Receivable turnover, 17.9 versus 7.2. So that is a positive as well. We're going to take a look at the estimates here. And what we look at is the GAAP estimates, which are general accepted accounting principles, which are good estimates as opposed to the pro forma ones, which are just kind of what the company wants you to look at. No, we want to look at GAAP earnings. Now, we do see the company did close, or the REIT closed at $46.96. The high for the year, $55.54. Right now, $40.50 was the low. Going out to December 2016, we see the GAAP estimate going forward is $1.07. Now, that's kind of strange. If I put a multiple of 15 on that, I get, $15 a share. The stock's at 46, so it's pretty expensive. I'll tell you, our REIT is nowhere near that. So this REIT is trading at, on a GAAP basis, almost 40 times earnings. That's pretty expensive. I would be nervous about that. I'll put it that way. So, and I will tell you too, and I don't generally look at this, but to kind of help you out, I do see out of 14 analysts, 10 give it a hold, 2 give it underperform, 1 gives it a sell. I think don't be fooled by just the dividend of 4.8%. This one may have topped out and maybe be dead water for years to come, or even worse, could drop down and lose you money. It might lose 10% per year, and that dividend won't make it up for you. So I do not like this REIT at all. There's other ones that I think are better priced. All righty?
Yeah, and did you get my other one that I wanted, the NOBL, the Vanguard ETF, or Dividend Aristocrats?
Unfortunately, we can only take one because we got other callers to go to there, Ted.
All right.
Okay, thanks
you.
you.
A lot.
Okay.
And welcome again, Dave. See you.
Thank you.
All righty. That opens on the phone line, 1-800-760-5362. That's 1-800-760-KFMB. And let's go out to La Jolla and speak with Chris. Good morning, Chris. You're on the Smart Investor. Brent Wilsey. How can I help you?
Yeah, Brent, I just wanted to talk to you about, by the way, congratulations with your son's joining the program. You must be a proud father.
I am a proud father, and I think Chase is very happy to be here.
Very happy.
Well, good luck to Chase and to you both. I'm calling about Lumber Liquidators. From what I can tell, the company is financially solid, but I would like your take on it.
Sure. Let me kind of go over the numbers with you and kind of share the numbers with you and the listeners here. Again, the company is Lumber Liquidators Holding Corporation, or Incorporated, symbol LL. PE ratio, very good, 13.8 versus 23.3. Price to sales, 0.54 versus 1.2. Price to book value, 1.8 versus 11.5. That's very attractive. And price to cash flow, 9.9 versus 16. So you've got some good valuation ratios there. Now, keep in mind, these are past earnings. We have to look at what's going forward. Sales for Lumber Liquidators, a year-over-year of 4.4%. Industry up 5.4%. However, earnings fell by 43% when the industry was up 24.9%. And we know this is partly because of the fact of that major story on 60 Minutes with all the problems. We've actually talked about this. I talked about it in a column. I've talked about it to my clients. It would take almost a whole show to explain more details on it. But what 60 Minutes did, I think, was not really correct. They used what they call a deconstructive test, which means you'd have to take off the first 2 layers of flooring to get to the formaldehyde that they're talking about. But the balance sheet, what I like about it, very strong. If you're going to buy a company in this situation, you got to make sure they got a good balance sheet. Current ratio 2.5 versus 1.2. That's positive. And what I really love about the company, 0 debt. The industry's at 141. So you got a nice balance sheet here that going through a storm, they seem to have a pretty good a balance sheet that can get them through it. Return on equity looks good, 13.1. Industry 41, which is pretty high. Net profit margin 4 versus 6.5, and inventory turnover 2.4 versus 4.2. And they are going through some difficulties right now because of people like, oh my gosh, should I not buy one of them? Buy them because of the fact that it's going to cause my family to have cancer or whatever. The problem's going to be with it. Just real quick, we've done in the past. We've looked at and bought companies like Merck when they had the Viax problem. We did Jack in the Box was my first one many years ago because of the E. coli situation. You've got to find companies that can weather the storm and not look at where they'll be tomorrow, next week, but we'll be through this in 12 to 18 months. And really have to understand what's going on with it. Let's just look forward to the earnings here on a GAAP basis. And going out to December 2016, the earnings appear to be $1.74. Now, if I put a multiple of 15 on that, I get stock price somewhere around 25, 26, and the stock did close at 21.04 on Friday. So it has a lot of potential, but you've got to understand, this past week, the insurance company said, we're not going to back you up, which contractually, I believe what I see, they do have to. And then also to the CEO quit. Now, you don't know if he was forced to quit or did he quit because he saw things, but I think this company is very interesting. I'll put it that way, but you've got to be careful because you have to understand what is going on with it. But we are watching it. I'll put it that way.
Yeah, my sentiments exactly, Brent. So we'll see what happens. Thanks very much and a very thorough analysis.
Well, thank you, Chris. I appreciate it. Have a good one.
You bet. Bye-bye.
Bye-bye. All righty. That opens the phone line, 1-800-760-KFMB. That's 1-800-760-5362. Let's go out to Terrasana and speak with Doug. Good morning, Doug. You're on the Smart Investor. We'll see. How you doing this morning?
Hey, pretty well. I've shied away from most of the banking stocks just because I think it's a den of snakes, particularly the money center banks. But I was looking at Wells Fargo, and knowing that it's I don't think it has the exposure or the past exposure to a lot of the scandals. And what do you think of the stock at this point?
All right, let me go Wells Fargo. And I will tell you one thing on banks you have to understand is that banks do well when rates go up because their spread can increase, which means their profits will increase. But you're right, you got to make sure you get the right banks. There's some very good buys out there. We hold 2 banks in our portfolio. Full disclosure, Wells Fargo is actually one of them. But I will also tell you we bought Wells Fargo back, I think, around $20 a share or so. Right now it's around $55. But let me go with the numbers for you, and we'll talk more about it as we go through. And you said you don't have it. Is that correct, Doug? You're looking at buying it?
No, I'm looking to buy.
Okay. All right. Again, the company is Wells Fargo, symbol WFC. PE ratio 13.7. That's above the industry at 13.3. Price to sales 3.4 versus 2.4. Price to book value 2. That's above the industry at 1.4. And price to cash flow looks good, though, 11.6. Versus 14.7. They do pay a pretty good dividend, 2.7%, and only use 34% of their earnings to pay that out. So I think we could see that dividend increase. Sales year over year are up 1.8%. The industry down 2%. Earnings per share grew by 1.9% when the industry fell by 15%. So I like that. They have a whole different balance sheet, being a banking stock. Their debt to equity 138 versus the industry at 313. Return on equity for Wells Fargo 13.3. versus 8.2, and net profit margin very good for Wells Fargo, 27.6. The industry, well, that checks in at 17.8. Let's take a look at the earnings estimates for you here going out to December 2016, see what they look like by the mean, the analysts here. And by the way, the stock did close at $56 a share on Friday. The high for the year, $56.70, the low, $46.40. December 2016, earnings per share estimates on a GAAP basis, $4.50. You put a multiple of 15 on that, you get a stock price somewhere around, 67 or so. We do use 16.5 as the number we use, so I think the target sell price is probably somewhere around 65 to 70, we'll call it. So I like it. But I've got to tell you, when I like Wells Fargo, we hold it in the portfolio. I have seen some other regional banks that I think will do well and have a little bit better value to them than Wells Fargo, even though Wells Fargo, a secret here, don't tell anybody else, it is on our buy list.
Okay, very good. So maybe a lot of the money to be made has come off the table already, but it's still operationally, it looks like it's a strong company.
Yeah, and I'm looking at maybe a year from now, the stock could be around 60 or so. You put in that dividend around 3%. I mean, I think going forward, not a bad return of, we'll call it, I think 10 to 13% is possible 12 months from now. By no means a bad return.
Okay, very good. Thank you.
All right, sounds good. Bye-bye. All right, 8:23. Let's go out to Rancho San Diego and speak with Scott. Good morning, Scott. You're in the Smart Investor, Brent Wilsey. How can I help you?
Good morning, Brent, and welcome, Chase, to the show.
Thank you very much.
And I think what we need to do, though, is he needs to pay his dues. You know how you're not running those courses anymore?
Yes.
I think that Chase ought to handle that.
Ooh, that's a good idea. Because, and what he's talking about, Chase, was I used to do like the seminars, almost every month or two. And because I'm so busy now, we don't do them. But to have you, and again, I will tell you, Chase is just about ready for that. I am impressed with how much he knows already with that. So, Chase, are you ready to start talking to...
I think I'm ready. I attended a few of them a couple years ago, but right. I think I could handle that pretty soon.
Yeah. You know what? That is a good idea, Scott. We didn't think about that because I think maybe, and we'll talk to Carol Ann, who's our marketing director, to say, okay, Carol Ann, let's set up some public seminars for people, which we did before. And I know that we're not kind of doing it just for clients, but what you're saying is like open it again for the public. Yeah. So that's a great idea, Scott. Thank you.
Okay. Well, you guys take care.
Okay. And also, Scott?
Yes.
You got to make sure you attend when we do one.
Oh, I will. I was pretty much, I think I only missed about 4 of them.
Oh, wow. Well, maybe you could run one. All right. Thank you, Scott. Have a good one.
Take care. Bye.
Bye-bye. All right. 8:25. We got Bob in San Marcos, Dorian in Englewood. If I take them now, because what time are we at? I've been doing the show for, 15 years. I still don't know when I... 2-3 minutes? Okay. You know what? Let me go ahead and go to Bob in San Marcos, and I'll try to get him through the break. Good morning, Bob. How you doing this morning?
Hey, good morning, Brett. Congratulations to Chase. It sounds great that he's joined your firm. Got to be proud.
Very proud, yes.
Yeah, I'm calling about a company called PriceSmart. They're the Costco comparative only in Latin America.
Oh, you know, and it's funny. And I saw that, and I thought PriceSmart was the pet company, but it's a different one there. So
They're actually based in San Diego as well.
yeah, that's right. They are. That's why they're so familiar. Okay, and do you hold that, Bob, or looking to buy it?
I don't. I've always been looking to buy it, and I was just curious to see what you think now that the dollar's coming down. So.
Okay, let's take a look at PriceSmart, symbol PSMT, PE ratio 28.3 versus 17.4. Price to sales 1 versus 0.56, and price to book value 4.8 versus 4.6, and price to cash flow expensive though 20.9 versus 9.6. You only get a 0.8% dividend. They use 24% of their earnings to pay that out. We do see sales are up 8.5%, industry up only 2.5, so that's a positive. However, earnings fell by 0.2. Must be tough in the industry here because earnings for the industry down 2%. We do see the balance sheet. We got a current ratio of 1.3. That beats the industry at 1.1. Debt to equity, very good, 19% versus 57.5% for the industry, so I like seeing that. Return on equity is 16.6 versus 19.3. We have a net profit margin of 3.6 versus 3.2, and inventory turnover 8.6 versus the industry at 6.8. That's good. And then receivable turnover is very good. It's 494 versus 38. And you know what I'm going to do, Bob, is that I want to go ahead and take the break. It's almost 8:27, so I don't want to put a damn behind here. I'm going to finish the second half of that analysis for you so I can spend some time doing it for you. And then also after you Bob, what we're going to do is we're going to have my conversation with Chase and I about what we talk about in the office and Tyson Foods. So stay with us. I'm Brent Wilsey and Chase Wilsey right here on AM 760 KFMB, the Smart Investing Show. We'll be right back.
This is Smart Investing on AM 760 KFMB. You can talk to Brent Wilsey right now. 1-800-760-KFMB.
Alrighty, welcome back to the Smart Investing Show. We have some phone lines open, 1-800-760-5362. That's 1-800-760-KFMB. And yes, it is Brent and Chase now, since Chase will be here every Saturday co-hosting the show. And actually, when I go away on vacation, he'll be the fill-in to help you get through the fundamental analysis of companies. And actually, a great call from Scott about having Chase do some public seminars for you to help you understand more about fundamental analysis. And we're going to go back to Bob and San Marcos. And then after that, we are going to talk more about what we talk about in the office with Chase and I about Tyson Foods. And before I do go back to Bob there, I do want to talk about one thing is our newsletter, which goes out every Tuesday morning. It's also on the San Diego Daily Transcript every Monday. But I wrote about a company I keep getting calls on. Actually, it's a master limited partnership, Alliance Resources, symbol ARLP. I won't give away too much, but I will tell you I went through the analysis of this master limited partnership, and I talked to our tax man Tracy Gaines about this, and there's a lot of twist to not just this one, Alliance Resources, but all master limited partnerships. And if you have one, if you don't understand them, you have to read this newsletter because it will really inform you. Go to my website, smartinvesting2000.com. That's smartinvesting2000.com. Just sign up for the newsletter. It goes out around every Tuesday around 10 o'clock. It is free, and I think every week you'll get something out of it. But especially if you're looking for high yield, which people are starting to do, looking at, I'll go to a master limited partnership, you've got to read that newsletter. Again, smartinvesting2000.com. All right, let's go back to Bob and San Marcos. Bob, you there?
I am.
Okay, good. So let's finish up. We talked about the fundamentals of it so far. Let's look at the numbers going forward on a GAAP basis. Again, generally accepted accounting principles. Going out to August 2016, obviously they're on a fiscal year basis. We see the GAAP earnings are $3.55, but a multiple of 15 on that. You get stock price around 50. Ooh, right now they're at 82. So I think they're already trading around 20 plus times earnings. So I don't like that. That is too expensive for the earnings. And again, people, I think they realize that we've not had a 10% correction in 3 years. Not to say we're going to have it tomorrow, but it just is not right to overpay for companies. And we have a hard time trying to find things to pull into the portfolio, but it is worth being patient. And I just don't think that, and you said you held PriceSmart or looking at buying it?
On the radar. But I think I'll just keep it there because, it does sound a little rich.
Yep, keep on the radar. And again, what you want is a pullback in it. And again, it could take a day, a week, a month, 6 months, but it's always worth being patient because patient investors are the ones who long-term make the good returns. Okay, Bob?
Thanks so much.
Okay, thanks for calling. Bye-bye. All right, so as I promised, we're going to talk about that. We're going to come up with a name for the segment, Chase. I think we're going to call it What We Talk About in the Office or something that people know we're going to
I think it's got to be more exciting than what we talk about in the office, but we'll think about that.
It's funny. I come up in the office, we have these things, and Tara goes, our portfolio analyst, she goes, don't you have a better thing than Monday numbers? Don't you? It's like, I guess I'm not good thinking up the names. I guess Caroline, our marketing director, should come up with names. It's kind of exciting. So, but we want to kind of share with you what we do talk about in the office and what we did this past week. We have a lot of companies we talk about, but one we want to pull out was Tyson Foods. Chase, why don't you tell us what you saw in Tyson Foods that made us talk about it?
Well, as I said before, Tyson Foods is an intriguing company, good product. Looking at their GAAP earnings per share estimate for September 2016, it's 3.69. Multiplying that by the 16.5 multiple gives us a target sell price of 60.89. The current closing price on Friday was 42.95, which gives us an estimated return of 41.77%.
And that's pretty exciting because, again, we like to buy them when they have a potential return of 30% or higher, so 41% is a pretty good growth there.
Exactly. Their fundamentals are very solid. Their valuation ratios are typically lower than the industry. Looking at their current PE is 16.9 compared to the industry of 25.2. Their current price to sales is 0.4, while the industry is 0.9. Their current price to cash flow is 11, while the industry is 12.95. So as I said, their valuation ratios are lower than the industry, which shows it's a solid buy. It might be a little undervalued. They pay a minimal dividend of 0.9. I mean, it's a dividend, but their payout ratio is 13.68. So maybe we could see them increase their dividend.
And how much of their earnings do they use to pay out that dividend? Does it show?
No, it just says the payout ratio is 13.68.
Okay, so that's what they use, like 13.8%. So that's less than 15% of their earnings they used to pay out. So they could definitely increase that if they want to. What else you seen in the company?
Well, the revenue over the last 12 months increased 14.58 compared to the industry, which decreased 1.8. So that's solid that they were able to increase the revenue, although the industry was falling. Unfortunately, their earnings per share were down 5%. Over the last 12 months, but the industry was down 15.91.
Now, did you get a chance to kind of look at the earnings, why they fell, or what?
They fell because there was issues with the exports. A lot of companies with the bird flu, a lot of countries with the bird flu are a little skittish on American chicken right now, so they kind of cut off exports. Okay. So they had some issues with that.
And maybe the strong dollar hurt a little bit too, because this is for the last quarter, and that we had that rising dollar.
Yes, exactly. That was another issue, so...
Yeah. So that kind of hurt the earnings there. And then, so far we sound pretty good. Anything that kind of worried you a little bit?
Their debt is a little high due to their recent acquisition of Hillshire Farms. Mm-hmm. While many people were a little nervous about their acquisition at first, it's shown that it was a solid acquisition. They made $77 million in synergies the last quarter, mm-hmm. and increased their estimate of synergies from $225 million to $250 million for the year. Mm-hmm. So they're very optimistic about it. But this did increase their debt and also increase their intangibles. Their intangibles on the balance sheet right now are about $12 billion. So that's a little nerve-wracking. And
what is the price of tangible book right now? Is it?
It's not on here right now, so we still have to wait, I think, a little bit.
And what it could be because if their intangible assets wipe out the book value, that's just too many. And so what you want to look at is that, and that really caused me concern because when I see those high intangible assets, if they had to be written down because of testing, that they're not worth what they paid for it. So Hillshire Farm is one reason why. So if they say they expected to earn this, and then a year from now it's just not performing, they are forced to write that down because it's not worth what they paid for it. Well, what that also does is it increases the debt to equity, causing you more problems with the company, and perhaps that could change it to where creditors get uncomfortable and will start forcing them to pay off their debt. They can't pay it off. They can be forced in bankruptcy. So that's why intangible assets are so important. So that would be something that, again, we kind of talked about to where, like, ooh, we liked everything else. I was so excited about it. Yeah. And then we got to that level like, oh, shoot.
Yeah. I mean, as I said, they're a very interesting company, but that is makes me a little nervous looking at that high intangible level. So
I think what we'll do is we'll eat the chicken, we'll eat the sausage, or whatever they make, but we won't eat the company, right? We won't take the company.
Yeah, not right now.
All right. Well, great job there. And again, we're going to do this every week, pull out one company. We talked about a lot of different companies this past week, a lot of different things. But we'll kind of share with you what we're talking about to help educate you and understand more about fundamental analysis and also give you companies to kind of look at. So, all right, phone number is 1-800-760-KFM. and that's 1-800-760-5362. Let's go up to Englewood and speak to Dorian, who's been very, very patient. Dorian, you still there?
Good morning, Brent and Chase. I'm here.
Oh, good, good. Thank you for being so patient there.
Yes, I want to mention one thing about Tyson Foods and that Chase mentioned, but the Jimmy Dean, the Hillshire brands, and the Ballpark Franks, I know where those came from. I used to own Sara Lee, and they used to Sara Lee, and they broke that up, and they also own Kiwi shoe polish. I don't think they got that one.
Wait, okay. I was going to say Tyson Foods is on Kiwi. Okay. All right, would hate to get that mixed up.
That's where they came from. But when I heard that, I knew right off where those came from.
Good. Yeah.
But the stock I wanted to talk about is Bemis.
Okay.
And you said, well, what is Bemis? Well, I was looking at the Dividend Aristocrats, and I was looking at the names, and I saw this thing called Bemis, and I said, what is this? Well, first of all, it's been around 150 years. That's good. It's a Dividend Aristocrat. That's good. And they make packaging. They make bubble packs. You go into AutoZone, that bubble pack, they make it. You go buy a pharmaceutical at Bonds and a little bottle of aspirin. That's what they do. And they're a global company, and they seem to be... I wanted you to check it out. BMS is the symbol, Bemis.
Okay, and I'm glad you explained what they do, Dorian, because I was going to ask you that, and you were reading my mind there, because what does Bemis do? And what I like about this, too, we'll look at the fundamentals, but it's what I call a big, dumb company that they don't do anything special. It's packaging. I mean, there's no technology that, again, you have to worry about, a new chip coming out or something like that. It's just a company that provides a great service.
I mean, it's packaging. A new chip, but... old package.
There we go. They package the chips is maybe what they do. So, okay, company is Bemis Corporation or company, symbol BMS. PE ratio, good start here, 19.9 versus 25. Price to sales, 1.1 versus 1. Price to book value is 19.6, which sounds high, but the industry, nothing there. So there may be a lot of intangible assets in this industry that causes no book value. Price to cash flow, 11.2 versus 9.5, so a little bit high. You do get a 2.4% dividend, which is not bad. That's better than a 10-year Treasury note. And they use 46% of their earnings to pay that out. Now, one thing I don't like is their sales are down about 0.7%, industry up 0.6%. However, earnings climbed by 20.4%, the industry up 5%. But I would want to know how they grew their earnings by 20% when earnings were, sales actually down a little bit less than 1%. Balance sheet, you got a current ratio of 2.6 versus 1.5. Debt to equity, 104 versus 284. And again, it's a little bit high. I would still maybe look at the company, but here I'd be looking at, is the debt going down? They're trying to pay it down, or is it increasing? Because it's increasing, that could be a problem that eventually have to sell this company because of too much debt. And also to remember, they do have a lot of intangible assets. Return on equity is good, 15.7, not quite as good as the industry at 20.5, but I'm still happy with that. We do see the net profit margin 5.5 versus 3.8, and receivable turnover 7 versus 7.4, and inventory turnover 5.5 versus 5.9. So let's take a look at the estimates here from the Gap site here, see what they look like here. And you said you don't hold this, or you're looking at buying?
No, I do hold it, and it's been going up.
Okay, and what kind of profit do you have in it now?
Probably about 30%.
Oh, good. Oh, very good then. Okay. Well, the stock did close at $46.96 on Friday. The high for the year, $49.44. The low, $34.34. Going out to December 2016, we see the earnings on a GAAP basis of $4.46. If I put a multiple of 15 on that, I guess stock price somewhere around, 65 or so. So, I mean, right now it's trading at about 10 times forward earnings. So that's a pretty good buy there. Chase, you might make a note of that one. Maybe we'll look at that one.
We'll take a look.
Yeah, so I like that then. Yeah, so Dorian, a good job here. I like that company.
Because I like it for the name. It's so stupid. But
yeah, I know. And nobody
used to call the Bemis paper bag company, and they changed the name to Bemis. But it's the old one.
Yeah.
It's global. And I wanted to ask Chase a question. What position did he play on the football?
I played linebacker.
Okay. And do you see any relationship between football and playing the game and financials?
Actually, we just read an article today about draft picks and finance, and how it talked about Tom Brady and Peyton Manning, and it's like, would you rather have Tom Brady, a 6th-round draft pick, pay him, I don't remember what he was making when he won the Super Bowl, but it was much less than what Peyton Manning was making when he won his Super Bowl. I thought that was very interesting. I mean, playing-wise, just a lot of discipline. you have to be a very disciplined investor if you want to make money and do the right things. And football definitely taught me a lot when it comes to discipline. So that definitely correlates.
And your schedule is pretty tough. I mean, you get up, 6 in the morning or something?
Yeah, get up at 6, go work out, go to school, go to lunch, go to meetings, go to practice, come home, go to sleep.
And there is strategy, right? They don't just play the game. They talk about how they're going to do it and take out this guy, and they're going to work on this. I mean, there's a lot of, it's like playing chess. It's a lot goes on behind the scenes, not just guys running around on the field.
Oh, yeah. A lot of people underestimate how smart football players are. I mean, I told my dad every day, it's just like, the plays are so much more complex than people really make it out to be. They're like, people just think you run around and hit people. No, there's a lot more to it. There's a lot more strategy. So definitely interesting sport.
Yeah.
Great. Well, anyway, I'm glad you're on board, Chase, and we're looking forward to hearing you and Brent.
Thank you very much.
On Saturdays.
Thanks, Dorian.
Okay. All right. Well, thank you very much.
Okay. Bye-bye. All right. 8:47. We'll take a quick break. When we come back, calls are up. Phone lines are open. 1-800-760-5362. That's 1-800-760-KFMB. Call in. You can talk to myself or Chase about your investment questions. We'll be right back.
This is Smart Investing on AM 760 KFMB. You can talk to Brent Wilsey right now. 1-800-760-KFMB.
All righty, welcome back. We have about 8 minutes left here on the Smart Investing Show. We're going to head up to, and before I head up to San Pedro, I do want to mention one more time about the news that we're talking about master limited partnerships. I've had a lot of questions on this one. It's called Alliance Resources, symbol ARLP. It is a master limited partnership, pays like an 8.5% dividend. People said, oh gosh, Brent, when are you going to look at this? Well, if you were questioning that, go to my website, smartinvesting2000.com. That's smartinvesting2000.com, and look for the newsletter section. There's a lot of things on there too, from past commentaries, past radio shows, but you want the newsletter to find out what my opinion was of Alliance Resource Partners, a master limited partnership paying about 8.5%. Okay, as I said, let's go to San Pedro and speak with Mark. Good morning, Mark. You're in the Smart Investor with Brent and Chase. How can I help you?
Hi, Brent. I was calling about Unilever, symbol UN.
Okay.
I don't hold it. I was just thinking of maybe investing in it.
Okay, well, let's take a look at it. Again, the company is Unilever, symbol UN. They are based in the Netherlands, and I'm surprised I'm actually able to pull up all the fundamentals on it, because a lot of times on foreign companies, Reuters, I have to go a whole different route here, but I'm actually being able to see this, which is good. So, again, company Unilever, symbol UN, PE ratio 22 versus 25.7, so that's a positive. Price of sales 2.5 versus 2.3. Unfortunately, the price to tangible book value is not material, and that's the same as the industry. And that means that, and I know that it's a big conglomerate. They bought a lot of different companies over the years, so they have a lot of goodwill in the balance sheet, which can cause you a problem when things slow down. And let you know, when I manage money, I'm always looking for how to protect my clients' money, not say, oh, everything's going to be fine. I always want to say I want to buy companies that are going to be good, even during bad times. So price to cash flow does look okay, though, 17.4. It was 18.7. You get a nice dividend, 3.2%, and they only use 35% of their earnings to pay that out. We do see sales were down 2.7%. The industry up 1.7%. Earnings look very good for Unilever, up 8%. While the industry fell by 0.5. We do see, a current ratio of 0.6 versus 1.15. That tells me virtually that they only have about 6 months of current assets to pay off the 12 months of liabilities. Not a good position. Many companies have gone bankrupt, not because they weren't financially strong, but because they couldn't pay their current bills. So I don't know why. I can't remember last time I saw a current ratio so low, so that worries me. I'd want to find out what their cash flow was and what they're kind of doing about that. Debt is a little bit high. It's 93, industry 108, but still with that low current ratio, that would worry me, having that much debt and such a low current ratio. Return on equity, very good, though, 36.9 versus 31. Net profit margin, 11.4 versus 9. We do see receivable turnover is 9.8 versus 7.5, and inventory turnover will show 0, which I know is not correct. That's kind of strange. The industry is at 5.4. Looking at the earnings, we will go out using the gas estimates here, go out to December of 2016. And you said you hold that, Mark, or you're looking at buying it?
I saw an article in Forbes about it, and the guy said that I don't hold it. I was looking to buy it. He said that at the back, I'm quoting here, he says, consumer discretionary stocks usually shine in the back half of a bull market. So he's saying that we're in the back half of a bull market right now, and so this stock is going to shine.
Oh, okay. All right. Well, let me look at the earnings here to see what they actually have there. We do see that going out to December 2016, the GAAP estimates are $1.99. If I put a multiple of 15, I get a stock price around 15. I do see that, and this is based on the euro, 39.45. And we see that the high is 42.75, the low is 28.75. So based on the earnings going forward, it's pretty pricey. And again, as I said, they had those intangible assets, and just not quite looking the way I kind of want them to look there. So, but yeah, I'd say there's got to be better companies out there. Okay, Mark?
Okay, thanks a lot.
All right, thank you. Bye-bye. All righty. Well, 8:55. Chase, we pretty much wrapped up the show today. A lot of times we talk about the economic information, and coming up this week, we talk about we're going to be looking at, and we do these posts almost every day for people. Our marketing director, Carol Ann, says, come on, we got to get these out for people, because I read them, and now Chase reads them to look at the economic information coming forward. On Tuesday, we got the April durable good orders. Now, this one, last period was 14 points, or it was 4.7 positive, now looking for a decline of 0.5%. And what that means, this is very volatile, because your durable good orders includes planes. And with planes, what happens, you're going to have big orders and low orders, and so it's very volatile. So we'll dissect that on Tuesday, how it is. And very important, at 10 o'clock Eastern Time on Tuesday is May consumer confidence. Last period, 95.2. Just a slight uptick is expected to 95.5. And I can't believe it's already April new home sales being released. Last period, 481,000. Now looking for an increase of 505,000. I made some comments on that, probably about a week or two ago. And then the big surprise will be on Friday, and maybe not a surprise. The preliminary first quarter GDP last estimate was 0.2% positive. They're now revising that down to a negative 0.7%. Now, I'm not really surprised on that. Chase, you've never been back east. I grew up back east, but the snow and stuff back east, people just don't want to go out, and people say, here, you've never, well, no, what are you talking about? Flagstaff had snow. How did you feel when it snowed in Flagstaff?
Not great. Didn't make me want to go out, go shopping. Just wanted to hang out at home, build a snowman, maybe cuddle up with a nice cup of hot cocoa, but definitely not go shopping.
Yeah, and it's funny, and your graduation day was, what day was that?
May 8th.
May 8th. And it snowed that day, which I was surprised. And it made me think, oh, yeah, I remember the snow. And people in San Diego just don't remember or know what it's like to have to go out in snow. You just don't want to go. It's too cold. And it was such a terrible winter back east that it really caused, I think, some problems there. So people don't understand it if you've never been in snow, but it is not good to go out in the snow or cold. And actually in Flagstaff, what was the coldest it ever got there? Do you remember?
There'd be some mornings where it was like negative 10. That was like 5 o'clock in the morning, but
okay,
there were definitely cold days.
Yeah, because I remember growing up in Schenectady, New York. The lowest I remember, it got down to a negative 30 degrees and a wind chill factor of a negative 60. And they close schools, they close buildings. It just gets very cold back east, and people will not be going out. You don't want to go out. Again, you just want to stay home and stay by the fire. You don't want to go out. So also on Friday, we have the May Chicago PMI, which is a Purchasing Managers Index. Last period, 52.3. Now 53 is the estimate. And then the May Michigan Sentiment, last period, 88.8, now 90. And if you want to get this information, go to Facebook, go to LinkedIn, go to Google+, go to Twitter. We release this information, and I give my comments on what I think about it, and it's all free on social media. So again, go to Facebook, Twitter, Google+, and LinkedIn. Just put in Brent Wilsey, and it'll all pop up. And even if you're your only friend on Facebook, that's okay. We'll still get you the information for you. All right. So, Chase, this week we got a short week. We got only 4 days. We'll be looking at companies. I know we started looking at a couple of the companies. What are we kind of looking at?
Looking at Best Buy. They have some intriguing prospects. Going to continue looking at Lumber Liquidators, I believe.
Okay, we don't give too much away, so we're going to stop there.
Okay.
Got to keep it wide in there.
Yep.
Okay.
Yep.
Alrighty, thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. You should call your own financial advisor to discuss your investments, or feel free to call me, Brent Wilsey, for a conversation at 858 858-546-4306. That's 858-546-4306. Or go to my website, smartinvesting2000.com, smartinvesting2000.com. Information is provided by Thomson Reuters and Barron's, one of the best investment magazines published every Saturday. Stay tuned for the Computer Talk Show with Larry Parlin. I'm Brent Wilsey and Chase. Sign off, Chase.
Thank you very much, San Diego.
All right, have a good day.
My way, regrets